Here are the crypto top headlines covered in this video. Ripple contests $2 billion SEC fine, says penalty shouldn't exceed $10 million. Next, Blockchain Association and crypto activist group sue SEC over dealer rule. Also, World Economic Forum says 98% of central banks are preparing to launch CBDCs as finance enters next phase. Welcome to Crypto Top Headlines, where there's no clickbait thumbnails or titles, and no speeches on my opinions, just bringing crypto's news to you. We have a quick request that doesn't cost you anything in order to help. Help us grow this channel to 1,000 subscribers by September, which would be our channel's 1-year anniversary. All we ask is that you click on the like and subscribe buttons, as well as the notification bell. By clicking on these, it does help grow the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline, Ripple contests $2 billion SEC fine, says penalty shouldn't exceed $10 million. Ripple said in a filing that the SEC's draconian remedial requests do not have grounds in law or principle. Cross-border payment protocol Ripple contested the United States Securities and Exchange Commission's request to impose a $2 billion fine against the blockchain company, saying the penalty should not exceed $10 million. In a new filing, Ripple Labs opposed the SEC's request to a federal judge to impose the almost $2 billion fine on the company. Ripple urged the court to deny the SEC's request for an injunction, disgorgement, and prejudgment interest. Ripple also said the court should issue a more reasonable civil penalty, which should not be more than $10 million, the filing said. Ripple has every intent of adhering to that guidance in the future and every incentive to do so. The SEC's draconian remedial requests are ungrounded in law or principle. This court should reject them in their entirety. The filing highlighted that the SEC asked the court to ask Ripple to pay $876 million in disgorgement, $198 million in prejudgment interest, and another $876 million in civil penalties. In total, the amount reached almost $2 billion. Ripple revealed the requested fine amount almost a month ago. On March 25th, Ripple Labs Chief Legal Officer Stuart Alderoty revealed that the SEC asked a federal judge to impose such fines on the blockchain company. The lawyer said the SEC remains bent on punishing and intimidating Ripple and the crypto industry. Within the new filing, Ripple described the fine as unreasonable and said that $10 million is the actual amount that reflects a portion of their actual revenues. Ripple redacted the actual percentage shared in the document. The filing also highlighted that such an amount would be proportionate in both percentage and dollar amount to comparable digital asset cases where there was no culpable mental state and no substantial harm or risk of harm to others. On X, Alderoty suggested that the SEC's actions and asked for the fine or proof of its ongoing intimidation against all of crypto in the United States. The Ripple lawyer said the case had no allegations or findings of recklessness or fraud. In addition, the legal officer believes that Ripple won on significant issues and hoped that the judge would fairly approach the final remedies phase of the case. Let me pause here for a moment. If you're getting value out of this video, please click on the like and subscribe buttons as well as the notification bell. Our next top headline, Blockchain Association and crypto activist group sue SEC over dealer rule. The Blockchain Association and a Texas-based crypto activist group are suing the SEC over its controversial dealer rule expansion, arguing it threatens the digital asset industry and innovation. The Blockchain Association and the Crypto Freedom Alliance of Texas, or CFAT, revealed a new lawsuit against the United States Securities and Exchange Commission in the Northern District of Texas, according to a statement. On April 23rd, the BA announced the lawsuit in a move to challenge the SEC's recent expansion of the dealer rule, which the industry groups argue stifles innovation in the U.S. digital asset market. The BA and CFAT argued that the SEC overstepped its authority by implementing a broad interpretation of the term dealer within the Securities Exchange Act of 1934. In February, the SEC adopted new rules which redefine dealer and government securities dealer and therefore require more crypto market participants to register, join a self-regulatory organization, and comply with federal securities laws. This expansion, the lawsuit claims, creates a vague and burdensome regulatory environment for businesses involved in digital asset trading. The lawsuit alleges that the SEC failed to adequately address public concerns raised during a limited comment period and neglected to assess the potential negative impacts of the rule. Kristen Smith, the CEO of the Blockchain Association, said this, the latest example of the SEC's blatant attempts to unlawfully regulate outside its authority. The dealer rule advances the SEC's anti-digital asset crusade and unlawfully redefines the boundaries of its statutory authority granted to it by Congress, threatening to drive U.S. companies offshore and incite fear in American innovators. The lawsuit seeks a court order to overturn the dealer rule expansion based on violations of the Administrative Procedure Act, or APA. The APA ensures fair and transparent rulemaking by requiring agencies to consider public feedback and provide clear guidelines. Smith said that they are seeking declaratory judgment and injunctive relief against the regulators to overturn the expansion of the rule and ultimately to prohibit its use against the industry before more harm can be done by this rabid regulator. The BA and CFAT represent a significant portion of the cryptocurrency industry, including leading investors, companies, and projects. Overall, their work advocates for a national policy framework within the U.S. that aims to foster local innovation and responsible development within the digital asset space. Our next top headline, World Economic Forum says 98% of central banks are preparing to launch CBDCs as finance enters next phase. More than 98% of the world's central banks are researching, experimenting, piloting, or deploying central bank digital currencies, or CBDCs, according to the World Economic Forum, or WEF. The WEF, a Switzerland-based international organization focused on public-private cooperation, predicts in a new report that there could be 24 live CBDCs by 2030. The organization argues that wholesale CBDCs, which are restricted to large transactions between financial institutions, could address banking industry challenges related to interbank payments and securities transactions. Central bank money, or CEBM, is crucial for interbank payments and securities transactions because it is virtually free of credit and liquidity risk, enables institutions to reach settlement finality, and promotes financial stability. CEBM is ideal for systemically important transactions despite the emergence of alternative payment instruments. Wholesale Central Bank Digital Currency, or WCBDC, is a form of CEBM that could unlock new economic models and integration points that are not possible today. WCBDCs promise to preserve the role of CEBM as a credit risk-free payment instrument by providing a foundational layer for digital payments in the next generation of financial markets. The WEF says WCBDCs are poised to improve cross-border transactions. The organization acknowledges, however, that the legal and regulatory elements needed to make widespread WCBDC use possible have an unknown time frame. So this concludes Crypto Top Headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.